One chip, three policy reversals, billions of dollars at stake. The export policy for the H20 chip to China went through a complete cycle in just 3 months, from ban to pause to restrictions, and finally to approval. This wasn't a policy mistake. This was a head-on collision between market forces and political intentions. Here's what happened. A Chinese company achieved the same results for $5.5 million that took Silicon Valley giants $100 million to accomplish. Chinese tech firms placed orders worth $16 billion for chips in a single quarter. Server prices skyrocketed 40% as panic buying swept the market. The market answered one critical question in the most direct way possible. Can tech restrictions actually stop innovation? This tug-of-war over the H20 chip is really about something much bigger. It's about industrial control, supply chain dominance, and the choice between competing technology paths. And the answer might surprise everyone. The AI industry had an iron law: more computing power equals higher costs. Silicon Valley built this entire logic of an arms race in computing. It dominated the industry for the past 5 years. Meta's training of Llama 3.1 deployed 16,000 H100 GPUs. It consumed 11 times the computing resources of DeepSeek V3. The price tag? Over $60 million. But DeepSeek's emergence tore open a crack in this logic. On core tasks like mathematical reasoning and code generation, DeepSeek R1 achieved performance comparable to OpenAI's O1. The training cost? Just $5.576 million. This cost gap wasn't just about optimization. It represented a fundamental divergence in technology paths. Through innovations like fine-grained expert partitioning in mixture of experts models, FP8 low-precision training, and multi-head latent attention mechanisms, DeepSeek achieved traditional model results using only 40% of the computing power. The market response to this cost revolution was immediate. Alibaba, Tencent, and ByteDance increased their H20 chip orders in the first quarter. The total exceeded $16 billion, a jump of over 40% quarter over quarter. But here's the kicker. DeepSeek's API pricing dropped to $0.014 per million tokens. That's just 1% of GPT-4's pricing. The significance of low-cost models isn't about being cheap. It's about breaking the monopoly that computing power holds over technological innovation. When small and medium enterprises can afford advanced AI, the boundaries of innovation expand from a handful of tech giants to the entire ecosystem. This algorithm efficiency paradigm proved something crucial. When the technology ceiling stops rising, optimizing efficiency beats piling on resources. This is exactly the scenario Washington feared most. Tech restrictions rest on one premise. Without enough computing power, you can't build good models. But when that premise gets demolished, the entire logic of restrictions starts to crumble. For NVIDIA, the H20 chip is both a commercial miracle and a strategic nightmare. The Chinese market generated $17 billion in revenue for NVIDIA. That's 13% of the company's total sales. But this 13% is special. It's not the most profitable market. It's not the most strategically important market, but it is the most politically sensitive market. The H20 chip was specifically designed as a downgraded product to comply with export controls. It was supposed to be a compromise solution. Instead, it unexpectedly became a blockbuster. From a product positioning standpoint, the H20's business logic is crystal clear. It's not as fast as the H100 for AI model training, but its bandwidth advantage in inference tasks is significant. This perfectly matched Chinese market demand. A massive number of companies needed to deploy models, not train them. Especially after DeepSeek's release, inference task demand surged. The H20's cost-performance advantage was fully realized. But NVIDIA faces a classic prisoner's dilemma. Keep supplying H20, and you preserve short-term revenue but potentially nurture competitors. Jensen Huang's concerns aren't unfounded. When foreign companies exit the Chinese market, domestic firms accelerate their own R&D. Eventually, they'll compete with NVIDIA in global markets. Stop supplying H20, and you immediately lose a tens of billions dollar market. First quarter inventory write-downs alone hit $5.5 billion. This dilemma stems from a deeper contradiction. The globalized business model of multinational tech companies fundamentally conflicts with the regionalized strategies of great power tech competition. NVIDIA tried to create policy space by promising to invest $500 billion in AI infrastructure in the United States. But this strategy of trading domestic investment for international markets remains fragile in the face of geopolitical logic. What's even more notable is the inversion of supply and demand. Because NVIDIA didn't secure enough capacity at TSMC in advance, Completing orders would take 6 months even with immediate production increases. When suppliers can't meet demand, the market opens up for alternatives. Behind America's H20 policy lies a seemingly sophisticated strategic logic. By supplying chips with limitations, Chinese AI companies would develop dependence on American technology. This would then hinder the development of China's domestic chip industry. This addiction trap theory holds up at the business level, but at the industry level, it has fundamental flaws. First is the negative incentive of policy signals. From planned bans to pauses, then to license requirements, the policy reversals themselves send a message to the market. Supply is unreliable. This uncertainty is more lethal than the bans themselves. Companies pushed H20 server prices up 40% through panic buying. At the same time, they accelerated their search for alternatives. Second is the hedging effect of industrial policy. The Chinese government is pouring billions of dollars into chip manufacturers. It's also requiring AI companies to use 50% domestic chips. This forced market cultivation, combined with the urgency created by tech restrictions, is forming a complete industrial closed loop. Third is the path dependence of technological evolution. DeepSeek's success proved a key point. Through architectural innovation and algorithm optimization, you can achieve similar results with weaker hardware. When hardware advantage is no longer an absolute barrier, algorithm advantage becomes the new competitive focus, and algorithm innovation is precisely the area that policy finds hardest to restrict. From an economic perspective, this strategic dilemma resembles a tech version of the middle-income trap, attempting to maintain high-end advantage by controlling mid-tier product supply. But the profits and technology diffusion effects of the mid-tier market are exactly what nurture new competitors. When the ban was lifted, the Hang Seng Tech Index rose 2.2%. Data center operator stocks surged 8.4%. The market expressed its recognition of the resilience of China's AI ecosystem through these gains. What's more ironic is this. The relaxation of H20 policy came within the context of US-China trade negotiations. The US wanted China to ease export restrictions on strategic resources like rare earths. This means chip restrictions ultimately became a bargaining chip, not an unmovable strategic red line. The greater significance of this chip game lies in how it's accelerating the fragmentation and restructuring of the global AI supply chain. From an industry chain layout perspective, Chinese domestic chip companies lag behind NVIDIA by about 5 years technologically. But this gap is being compressed by two forces. One is policy-driven market protection. The other is differentiated innovation in technology paths. Once DeepSeek demonstrated the viability of the algorithm efficiency paradigm, dependence on top-tier computing power decreased. This won precious catch-up time for domestic chip companies. From a business model perspective, the proliferation of low-cost AI is changing the profit distribution across the entire industry. API prices dropping to 1% of GPT-4 means the marginal cost of AI applications has dramatically decreased. This doesn't just lower the barrier to entry for small and medium enterprises. More importantly, it shifts the focus of industry competition, from who has more computing power to who can apply AI more efficiently. From a geo-economic perspective, the unintended consequences of tech restrictions cut both ways. America lost some market revenue, but it also forced China to accelerate its path to self-sufficiency. China has about half of the world's AI researchers. It spends more on chips than any other market in the world. This massive market and talent pool is forming a relatively independent innovation ecosystem under policy pressure. Most noteworthy is the potential divergence of industry standards. When two technology paths can both achieve similar results, high computing power plus high cost versus optimized algorithms plus cost control, the global AI industry might see a dual standard landscape emerge. This isn't just a divergence of technical roots, it's a redistribution of industry discourse power. After NVIDIA resumed H20 sales, the market's positive response indicated something. Capital has formed a consensus that tech restrictions will ultimately fail. This consensus itself confirms that supply chain restructuring is irreversible. Policy can restrict chip flows, but it cannot stop the diffusion of innovation. When $5.5 million can achieve what $100 million does, the balance of tech competition has already shifted, from resource-intensive to intelligence-intensive. The three reversals of the H20 chip are essentially a game between market laws and policy intentions. And in this game, economic laws will ultimately prevail. The real question isn't who owns the most advanced chips, it's who can create the greatest value with limited resources. That answer is being rewritten right now.